So here's the thing about the Roth IRA that most people don't realize until it's too late. You can do everything right on the way in. The conversions, the bracket filling, the years of careful tax management, and then make one wrong move pulling the money out and hand a chunk of that tax-free advantage straight back to the IRS. And the painful part is that none of these mistakes announce themselves. You don't get a warning. You don't get a second chance. You pull the money, you file the return, and you find out what it cost when the bill arrives. 7 specific withdrawal mistakes will do this to you. And every single one of them is being made right now by men who built the Roth carefully, protected it patiently, and genuinely believed they understood how it worked. Some of these are technical traps, rules the IRS designed in ways that are almost intentionally confusing. Some are strategic errors, pulling from the right account at the wrong time. And some are planning gaps, decisions that look fine today and create damage years from now. All 7 are avoidable, but only if you know they exist before you pull a dollar. So today I'm walking through all 7. What each mistake is, why it happens, exactly what it costs, and what to do instead. And I'll tell you right now, mistake number 3 surprised me when Frank, my tax guy of 15 years, first explained it to me. Because I thought I understood the 5-year rule, I didn't understand it as well as I thought. Let's go. By the way, my name is Edward Gray, and I'm a retiree just like you. On this channel, I share what I've learned from my own retirement, my own mistakes, and the conversations I've had along the way, so you can see where you stand and what you might do differently. If that sounds like something you want more of, hit subscribe and become part of this community. And while you're down there, drop a comment. Have you ever pulled money from a Roth and wondered afterward whether you did it right? Tell me where you are. All right, let's get into it. The first one is something I see men get wrong constantly, and it's specifically because the way the 5-year rule gets talked about makes it sound like one rule when it's actually 2 completely separate rules running on 2 completely separate clocks. Most people know there's a 5-year rule for the Roth. What most people don't know is which 5-year rule they're thinking about. Here's how it actually works. The first clock, the account clock, starts on January 1st of the tax year you made your very first Roth IRA contribution. Ever. Not this account, ever. If you opened your first Roth in 2018 and contributed to it, that clock started January 1st, 2018. Once 5 years pass and you're 59 and a half or older, your earnings come out completely tax-free. And that clock runs once per person. If you open a second Roth IRA in 2024, the earnings clock doesn't restart. It's still running from 2018. The second clock, the conversion clock, is completely separate and runs differently. Every time you do a Roth conversion, that specific conversion starts its own individual 5-year countdown. If you converted $50,000 in 2023, that conversions clock started January 1st, 2023 and expires January 1st, 2028. If you convert again in 2025, that conversion has its own clock starting January 1st, 2025, expiring January 1st, 2030. And if you're under 59 and a half and you withdraw converted money before its individual 5-year clock expires, you owe a 10% penalty on the taxable portion of that specific conversion. Even though you already paid income tax on it when you converted, and even if your account clock is satisfied. The 2 clocks are independent of each other entirely. After 59 and a half, the conversion clock no longer triggers a penalty, so you can pull converted money anytime. But the account clock still governs whether earnings are tax-free. So if you're 60, your account is 4 years old, and you pull earnings, those earnings are still taxable because the account clock hasn't hit 5 years. So open a Roth as early as you can, even with a small amount, specifically to start that account clock running. And if you're doing annual conversions over multiple years, track each one's clock separately, because the IRS tracks them separately whether you do or not. Now that leads me to the second mistake, and this one actually works in your favor when you understand it, but creates expensive confusion when you don't. It's about how the IRS decides which layer of your Roth you're actually pulling from when you take money out. When you pull money from a Roth IRA, the IRS doesn't let you choose which layer comes out first. Contributions first, conversions second, with oldest conversion first, and earnings last. Why does this order work in your favor? Because contributions can always be withdrawn at any time, at any age, completely tax and penalty free. You already paid tax on them when they went in. There's nothing left to collect. So if you need $15,000 from the Roth and you've contributed more than $15,000 over the years, the IRS treats your withdrawal as coming entirely from contributions. Tax-free, penalty-free, no 5-year rule applies. Most people either don't know this rule exists or they avoid the Roth entirely because they're afraid of accidentally hitting the earnings layer. For most retirees with years of contributions behind them, the contribution layer is substantial and protects them from the more complicated layers for a long time. But here's where it goes wrong. Men who don't understand the ordering assume all Roth withdrawals are equally clean. They pull large amounts without tracking which layer they've reached, or they make one large withdrawal, a home repair, a car, that blows through contributions into conversions that haven't hit 5 years and into earnings. 3 different tax and penalty outcomes from one pull, and none of it visible until tax time. So know your layers before you pull. How much is contributions, how much is conversions, and when each converted, how much is earnings? That breakdown tells you exactly how much you can pull cleanly right now and when. Now that brings me to the third mistake. And this one specifically catches men who opened a Roth later in their career, which is a lot of men watching this channel. They did everything else right, and they still got hit. Because they made one assumption about age that the IRS simply doesn't honor. Because the logic seems completely reasonable. You're over 59 and a half. The Roth was designed to be tax-free, so withdrawals are tax-free. Except for one condition most people forget. The account clock, the 5-year rule on earnings, applies regardless of age. Even if you're 61, if your Roth account was opened less than 5 years ago, your earnings are still taxable when you withdraw them. The penalty doesn't apply after 59 and a half, so you avoid the 10% hit. But the earnings portion of the withdrawal is still subject to ordinary income tax until the 5-year clock is satisfied. Here's what that looks like in practice. A man retires at 58. He opens his first Roth IRA and starts doing conversions. He's careful with the bracket, watches the IRMAA thresholds, does everything right. At 61, he needs extra cash and pulls $40,000 from the Roth. No penalty because he's over 59 and a half. He assumes it's completely clean. But his account clock started in 2023 when he made his first contribution. It's 2026, 3 years in, and the earnings portion of that $40,000 is still taxable. He owes ordinary income tax on something he genuinely believed was going to be free. So open a Roth as early as you can, even a minimal amount specifically to start that clock running. Even a small contribution in your late 50s gets the clock going so that by the time you're deep into retirement, the earnings are long satisfied. Now, the first 3 mistakes are IRS technical traps. Rules that hit you if you don't know they exist. The fourth mistake is completely different. No rule gets violated, no penalty arrives, everything looks fine. But you still made an expensive strategic error that compounds quietly over years without ever announcing itself. And that's pulling from the Roth in a low-income year, when the IRA would have cost you almost nothing. Here's the situation. Say you have a year with unusually low taxable income. Maybe you had large medical expenses that give you a significant deduction. Maybe a business loss. Maybe a year where income from all sources just happens to land low. In that year, a traditional IRA withdrawal might be taxed at 10 or 12%, or possibly close to zero after deductions. If you pull from the Roth that year instead, you use a tax-free resource in a year when the taxable alternative was almost free. Anyway, you've wasted the Roth's advantage on a situation where it wasn't needed. And here's the compounding cost. Every dollar you leave in the Roth is a dollar growing tax-free for the years when your income is higher. When Social Security is running, when RMDs are adding to the income picture, when you're in a higher bracket. The Roth is most valuable in your highest income years where it lets you pull cash without triggering additional Social Security taxation, without crossing IRMAA thresholds, without adding to a bracket that's already elevated. Using it in a low-income year wastes that strategic value on a situation where it wasn't needed. The right move in a low-income year is to pull from the traditional IRA, take advantage of the unusually low bracket, and let the Roth continue compounding for the years when it does its most important work. Frank, my tax guy, reviews our income picture every fall, specifically for this reason. We're looking for the years when IRA withdrawals are cheap and the years when they're expensive. The Roth gets used in the expensive years. The IRA gets used in the cheap years. That sequencing alone over 15 or 20 years is worth tens of thousands of dollars. Now, the fifth mistake surprises a lot of men who think they've fully figured out the Roth. Most people know it's invisible to federal income brackets, Social Security taxation, and IRMAA. And that's largely true. But completely invisible to everything in every situation? That assumption has a specific blind spot that catches grandparents off guard more than anyone else. FAFSA, the Federal Financial Aid Form for college, counts Roth IRA distributions as income. And this catches grandparents completely off guard. A grandfather who has a grandchild applying for college financial aid pulls $30,000 from his Roth to help with tuition costs and genuinely believes it won't affect anything. Because Roth withdrawals are tax-free and don't show up as income. Except on the FAFSA, they do. That $30,000 shows up as untaxed income in the aid calculation and can meaningfully reduce the grandchild's financial aid eligibility for the following year. The better strategy for grandparents helping with college is to either use contributions from the Roth, which are treated differently than distributions, or to wait until the student's final year of school to pull from the Roth when there's no subsequent FAFSA year for the distribution to affect. And while we're here, some states calculate their own version of income-related Medicare adjustments differently from the federal IRMAA formula. A few states include Roth distributions in their calculation. If you're in a state with its own Medicare supplement or healthcare premium structure, confirm with your tax advisor how Roth withdrawals are treated in your specific state. The Roth is close to invisible for federal purposes, but completely invisible in every situation and every state. That assumption has specific gaps that can cost you. Now, with the first 5 mistakes all affect what happens to your money while you're alive. The sixth mistake affects what happens after you're gone. And I've found that men almost always have the wrong assumption about this because the old assumption used to be true and the law changed without nearly enough people noticing. Most men assume the Roth they leave behind is completely and indefinitely tax-free for their heirs, that their children will receive it and let it grow tax-free for decades. That assumption was true before 2020. The Secure Act changed it. Under current law, most non-spouse beneficiaries who inherit a Roth IRA must empty the account within 10 years of the original owner's death. The withdrawals are still tax-free. That advantage is preserved. But your daughter can no longer treat it as a decades-long tax-free growth vehicle. She has 10 years to empty it, and if she's 50 and in her peak earning years when she inherits it, she's taking significant distributions annually on top of her existing income for that full decade. Now, this doesn't make the Roth a bad inheritance. It's still dramatically better than a traditional IRA. An inherited traditional IRA in the same 10-year window creates a large taxable income problem every year. An inherited Roth distributes cleanly and tax-free regardless of her bracket. The 10-year rule doesn't make the Roth worse, it makes knowing the 10-year rule essential for planning which accounts you deplete in what order during your lifetime. Which means you generally want to draw down traditional IRA assets first through deliberate withdrawals, manage the bracket carefully, and preserve the Roth as long as possible, both for your own late retirement strategic flexibility and because it's the cleanest asset to leave behind. Surviving spouses have different rules. They can roll an inherited Roth into their own account and treat it as their own. The 10-year rule applies to children, grandchildren, and other non-spouse beneficiaries. And that brings me to the last mistake. And this one ties all six together into a single habit that either protects the Roth over your entire retirement or quietly drains it of everything that made it valuable in the first place. The Roth is the most valuable account in your retirement. And its value isn't just that it's tax-free. It's specifically when and how that tax-free status does its most important work. It does its most important work in your highest income years, when pulling from the IRA would trigger Social Security taxation or push you into a higher IRMAA tier. It works hardest after a spouse dies when the surviving spouse is filing as a single filer with narrowed brackets and provisional income thresholds that create a much heavier tax burden on every other income source. And it's the cleanest inheritance you can leave. Tax-free distributions to heirs who are in higher brackets than you're in now. Men who understand these three use cases protect the Roth deliberately. They pull from it specifically in the situations where its invisibility to Social Security taxation, IRMAA, and ordinary income brackets creates the most value. Men who treat it as a convenient account to pull from whenever they need. Cash spend down that strategic value in low-stakes situations, then find themselves without the tool when the high-stakes situations arrive. So before every Roth withdrawal, ask one question. Is this the situation where the Roth does work that no other account can do? If Social Security is running and an IRA withdrawal would make more of it taxable, yes. If you're approaching an IRMAA threshold and need extra cash, yes. If your spouse has passed and you're navigating the widow's penalty as a single filer, yes. If your income is low and the IRA would be cheap, use the IRA. If a taxable account can cover it without tax consequences, use that instead. The Roth is the sharpest tool in the retirement toolbox, and the sharpest tools deserve to be used on the jobs only they can do. All right, 7 mistakes. 2 5-year clocks you need to track separately. The ordering rules that determine which layer you're actually pulling from. The account clock that still applies after 59 and a half, even without a penalty. The low-income year trap, where the IRA was nearly free and you used the Roth anyway. The FAFSA blind spot that catches grandparents off guard. The 10-year rule your heirs will face under the Secure Act. And the discipline of reserving the Roth for the moments when its tax-free status does its most important work. None of these are complicated once you see them, and all of them are invisible until you run into them. Usually at tax time, usually after the decision that can't be undone. Drop a comment and tell me which of these 7 you hadn't thought about before today. And if you've already made one of them, no judgment. Tell me which one. Because the men who come after you in this community need to hear that it happens to careful people too. And if today gave you something worth acting on, share this with someone who has a Roth and thinks the rules stop at put the money in and it grows tax-free. Because the rules don't stop there, they just get less talked about. And if you're not already part of this community, come join us, because this is what we do here. Real rules, real retirement, from guys who are actually living it. Hit the subscribe button and ring the notification bell. See you in the next one.